Welcome all, Richie Owens here from markmeldrum.com. Just a quick little video that was born out of a discussion I had with a level 2 retake candidate, somebody who'd seen level 2 in 2023, retaking in 2024, and had heard that defined benefit pension plans are no longer in the curriculum. Not true. It is true that the reading on employee compensation has shifted to focus more on share-based compensation, but defined benefit plans are still in there. However, a lot of the information, a lot of the techniques you would have learned in 2023 are no longer necessary. It's not a focus on total periodic pension cost and so on. But you do still need to be able to read a set of pension disclosures and understand the impact of changing assumptions. So with that in mind, let's take a look at General Electric. I have their 10K here for 2023. I've picked General Electric because they have a large defined benefit plan, a deficit, and some interesting changes in assumptions. So let's start with the plan's funded status. What I'm going to look at is 2022 and just the principal pension, because they're kind of some big juicy numbers and some interesting changes and assumptions that we can deal with. This is the end of 2023's 10K, so you can certainly roll it forward and look at the other numbers yourself, but these have some quite juicy changes in there, as I say. Now, I've taken those basic reconciliations of the obligations and plan assets and put them into a pro forma, as you can see over on the left, and we're going to use that along with a couple of other notes to construct the income statement and OCI. And that is certainly something you still need to be able to do at level 2 in 2024. Go through the notes and tell me of all the costs of this plan, which go to the income statement, which go to OCI. So let's do exactly that. Focusing on my pro forma, we start with an obligation of 72,299. We have a current service cost of 221. Under US GAAP and IFRS, that current service cost of 221 is part of the income statement expense. Moving down the reconciliation, we have 2069 as interest cost. Under US GAAP, that 2069 is part of the income statement expense. If this were IFRS, it would be netted against return on assets, both calculated using the discount rate. You see it on one line. Under US GAAP, you see 2069 as the cost, and then we would see separately an expected return on plan assets. We'll have to go to another bit of the disclosures to find that. But continuing with the obligation, we've got the opening, the service cost, the interest cost, participant contributions, 14 paid by employees. That will increase our obligation. We owe it back to them, and increase our plan assets. You can see down here, 14. It's a wash. It's not part of the cost of the plan. It doesn't go to the income statement or OCI. Then the big number, the reason I've really chosen these disclosures to look at. 17,281 there in parentheses in my pro forma. Let's get back into the GE notes, and we can see it right here. 17,281. It is in parentheses, which means it's an actuarial gain. We have a note. It says A. Let's go down to note A. Not sure if the font's big enough for you to read on the screen, but it says primarily due to impact of discount rates. It's in parentheses here. It is reducing the benefit obligation. What would we need to do to a discount rate to reduce the obligation? The obligation is the PV of all of our future payments. Well, if it's been reduced, it must be because the actuary increased the discount rate. And if we scroll up in the disclosures, we can see exactly that happening. In 2021, last year compared to the year I'm looking at, for the principal pension, discount rate of 2.94. This year, in our principal pension, 5.53. That is a hike of 259 basis points. Increase the interest rate, or rather the discount rate, you decrease the obligation. That's what's led to that massive number, that 17,281 that we see in this reconciliation of the obligation. Where does it go? Well, it is part of the cost of the plan for the year, but because it's an actuarial change, it goes to OCI. Our hope is in the long run, all of these actuarial gains and losses will net out to zero. It's in parentheses there because it's a gain. At the top here, when we're looking at income statement and OCI in these pro formas, positive numbers are expenses. So in parentheses here, that is reducing the expense because it's a gain. Why a gain? Because we reduce the obligation. And then finally, in this reconciliation of the obligation, we have the 3731 benefits paid. Again, not part of the cost. It reduces the obligation because it's paid. It also reduces our plan assets because we use the assets to pay it. So the 3731 comes out of the obligation and the assets. It's a wash. It's not part of the cost. That deals with all the numbers from the obligation. What about the plan assets? Starts at 6990. So we brought that into our pro forma. And then we have the other big interesting number from this year. The other reason I chose this year, we have an actual gain or loss on plan assets. And because it's in parentheses, it is a loss of 12,605 in there. Now, where does that go? Does it go to the income statement or OCI? Well, it doesn't go directly into either. To find out what happens to it, we need to look at a different disclosure. This is our funded status. If we roll up, we can see what they put into the income statement and into OCI, or the income statement primarily on this disclosure. And as they should under US GAAP, what GE put into their income statement was not that actual loss on assets, but instead the expected return. What is the expected return, you may ask? It's a good question. That is the return the actuary expected our assets to generate. Here, it was 3142. Again, be careful. We're in an expense disclosure here. So anything in parentheses is reducing that expense. It is income. So the actuary expected 3142 of income. That's what they took to the income statement. Let's put it into hours. Again, negative because it's reducing the expense. But why 3142? Let's take a look at the disclosure, see if we can find out. We scroll back through the status. We're told down here we have some assumptions that are being used. Actuarial basis, yep, we know various assumptions. Yet discount rate we've talked about. Compensation assumptions we haven't talked about yet. And expected return on assets and mortality rates. The expected return on assets is an assumption the actuary will give us. We scroll down and look at the plan assets. We can see their breakdown. And in the detail up here in this paragraph, you should be able to pick out an assumption of a long-term expected return of 7%. The actuary has used that and the asset balances throughout the year to come up with that expected return of 3142. Back to the funded status. Dealt with the 12,605. Employer contributions of 325. That's money paid by GE to the pension plan. Not part of the cost, that's the payment of the cost. So we don't need to stress about that for the income statement or OCI. And the participant contributions and the benefits paid, we already dealt with and talked about from the obligation. So that deals with everything in our obligation and assets. Let's see where it leaves us. Well, at the start of the year, we had a benefit obligation of 72,299, plan assets of 6990. That means on January the 1st, we had a deficit of 11,309. That's the difference between the 72 and the 60. By the end of the year, December 31, that was down to 8,598. And you can see that, the funded status in GE's disclosures. So you need to be able to do that, pick that disclosure apart and understand where the numbers are going. But we haven't quite finished the income statement and OCI yet. What have we got in the income statement? Well, the 221, 2069, 3142, that's fine. We've got a bit of amortization missing. OCI, we've got the actuarial loss. But look at this big number we need here. Expected versus actual return on plan assets. Look what we've done so far. We've put a return of 3142 into the income statement. But we know, actually, we lost 12,605. If we leave it like that, we are lying in the accounts. 3142 positive when actually we lost 12,605. That is a difference of 15,747. That is another actuarial adjustment that we put into OCI. This time, it is a loss. We put a gain of 3142 into the income statement. The truth was we lost 12,605. We need to put a loss in OCI of 15,747. If we do that, together, the income statement of 3142 and the OCI of 15,747 net out to the true figure of 12,605. That leaves only the amortization. This, remember, is General Electric. As we've said, we're using US GAAP. And the most common treatment for actuarial gains and losses under US GAAP is to take them directly to OCI, as we have here, and then gradually, typically over the remaining service life of employees, amortize them back into the income statement. To find out how much amortization they charge, let's go back up to our expense disclosure. And for 2022 in the principal pension column, here we go. Amortization of net losses, 1422. Amortization of prior service costs, 5. Neither is in parentheses, so they are costs. So from prior years into our pro forma, we can show an expense from amortization of 1422 from actuarial losses and from prior service costs 5. If this were IFRS, prior service costs would have gone directly to the income statement. Now, where did they come from? We've just said they came from OCI. So if you're putting that amortization into the income statement, you must remove it from OCI. Remove it from OCI. This is a wash. We're just recycling. Something that was sat in OCI is now in the income statement. And we're done. Let's total everything up just to make sure it looks logical. Income statement expense is 575. Can we find that in the disclosures? It's staring us in the face right here. That's the 575. OCI, 2961. It's in parentheses. That's an overall credit. Can we find that in the disclosures? Well, let's scroll back down. Past our funded status, past the assumptions and the assets we looked at earlier. And we get a disclosure on what's gone to comprehensive income. We are in still the same year we're looking at, 2022, the principal pension. Total charges or changes rather in comprehensive loss or income. There you go, 2960. We seem to have picked up a 1 difference there in rounding, but that's the 2960 that we are looking at. Tremendous. So we know how to pick apart a set of disclosures. We know where to find the key numbers. And we know how to put them and split them into the income statement and into OCI. Now, if you're a veteran of 2023, you're probably itching to go further. So let me just take an extra minute to say, look, you might be thinking, surely, Richie, we want to go on and say some interesting stuff about the movement in the fund, the contributions, and these total expenses. And I would agree. This is not strictly necessary anymore, but I think is useful to test your understanding of what's happening here. Look at what happened. We went from January the 1st, a deficit of 11,309, to December 31st, a deficit of 8,598. That is an improvement. In the deficit of 2,711, the deficit decreased. That was despite GE only making contributions of 325. Well, if their pension deficit improved by a massive 2,711, despite them only paying 325, the cost of the plan must have actually been not a cost but income of 2386. If you pay 325 and it improves by 2711, somehow there was a negative cost to that plan of 2386. That should be what we're putting through our accounts for the principal pension plan in 2022. Let's see if we have. Well, there are only two places where we put costs: the income statement and OCI. 2961 as a credit, 575 expense in the income statement. If you net those two off, we do indeed get 2386. The total cost, or in this case, income from the pension plan, can we find that in the disclosures finally? Well, there we are. The cost or income, in parentheses, it's income, of the plan for the year, 2385. I got 2386. That's that one of rounding we picked up somewhere along the way. And that's it. My intention here, first of all, to point out that defined benefit plans are still in the curriculum, albeit scaled right down. Secondly, can you pick apart a set of disclosures, find the assumptions, what's changed, and what the impact of that change is going to be on your obligation and your pension cost?